So my name's Dan Coatsworth. I'm editor of Shares. Today I'm just going to talk to you about, is this the perfect stock? This is an amazing chart. And I don't know if everyone can see this exactly back from where they are, but it shows a company on AIM that's increased by more than 18 times in value since 2010. Now, before I name this company, I'd like to see if anyone here in the audience now would buy this share simply by seeing that chart. Is anyone, put your hands up, you would buy that? Okay, good, right. So in the price in January 2010 was 17.5 pence. The price now is just over £3. Now that's a really, really good return, and that's not even including dividends. So this is the company, Restore. Some of you may have this, may not even heard of it. But whether you are, or were, or going to be a shareholder, I'll talk to you about the bull and bear case today. I think it's a fascinating example, and even if you just use it to study how you look at companies, it's really, really worth looking into further. Some of my colleagues at Shares say this is probably one of the most boring companies, and I think boring is beautiful. This is a great, arguably reliable, but for how long, company. So Restore's a document storage business. I'm not talking about the cloud. This isn't data centers. These are bits of paper in a boring old cardboard box that sit on a shelf. It gets involved in the storage of them. It shreds things. It does scanning, IT recycling services, and office removals. I mean, you can't get a more unattractive story, but please, please bear with me on this. The business is valued at just under £300 million today. But in 2009, it was worth 1.5 million. It used to be called Mavinwood, and it did insurance services. Things like if your drains got stuck, damaged carpets from a flood, but it nearly went bust. Had high fixed costs, lots of debt, and naughty didn't pay its taxes. So it sold all the rubbish stuff, sorted out its finances, and started on a journey of buy and build of the UK document storage industry. And as you can see by the share price, the strategy's clearly worked. It has high levels of recurring revenue, significant support from institutional investors. They got rich, shareholders got rich. The big question now is, if you bought it today, can you get rich? Now, some of you in this room may want evidence of a rising share price before you would even look at a stock. It may suggest a business is doing well. Certainly shows there's positive sentiment from the market towards it. But for others, you may think, I've definitely missed this. The rally's too late. I was talking to someone earlier on the stand, and they said they used the word Johnny Hindsight. You would never touch this. But of course, you wish you were there. So really, Restore, this is the bull case. So Restore has used its AIM quotation very, very well. It's tapped the capital markets for money to help support its growth. A lot of people think raising funds, issuing new shares is bad. It is if they do it at a big discount. But if they do it cleverly and explain why they are needing money to grow, it can work well. That's why companies are on the stock market, to access the capital markets. Now, Restore's also had lots of interest from people wanting inheritance tax benefits. Now, certain companies on AIM, if you hold them for 3 years or more, depending on where the company earns its money, they can qualify yourself as an investor for tax benefits. Restore certainly qualifies, so it's been a big favourite amongst IHT funds and from wealth managers with customers wanting IHT solutions. That means there's been very little people trading in and out of this stock. These are long-term investors. None of this liquidity that you get with mining stocks and story tech stocks. These investors are attracted to the recurring revenue. This is the idea that you win a client, gives you some money, and then that's it. You don't do anything. But every year, the client gives you more money, more, for doing nothing, essentially. Why wouldn't you want to invest in a stock like that? Once you've got these boxes stored with Restore, it's very rare that one of its customers is going to go, well, I can go somewhere else for slightly cheaper. They just can't be bothered. They're moving all boxes to save a few pence. That's another reason why the shares command a high rating. This is annuity-style earnings. This is a company with very high operating margins. Slow and steady growth is really attractive for an investor wanting a buy and hold investment. A company pays a fee to store the boxes and has to pay another fee if it wants to get something out of these boxes. And a stockbroker was saying the other day in a report that Restore is looking at its first price hike in a number of years. Even more money for Restore. One of its places it stores the documents, this is Underground Bunker in Wiltshire. I've been there, it's a fascinating place, full of a labyrinth of tunnels. All that's in there are shelves with boxes on. There's no big capital expenditure requirements. There's no technology that needs updating. You can see here there's some empty space. The only money it had to spend was to put some more shelves there. It's also got things like aircraft shelters as well in Oxford. But its customer base is brilliant. 43% of the FTSE 100 companies use its services. 80% of the top 25 UK accountancy companies. 64% of the legal practices. And it's got local authorities, national health trusts. This business is generating serious levels of cash, but rather than paying attractive dividends at the moment, it pays a small bit, but it keeps that money to reinvest in the business for M&A. But, and here's the big but, what if it can't find anything decent left to buy because it's already got all the best targets? That could imply more cash for investors in the future, more generous dividends. Now you may ask, what about digital storage? Well, Restore offers the ability to scan the documents that's in a box, but it says most customers can't be bothered to do that. And also, you've got data breach concerns at the moment. It's actually giving more life to printed documents. Now, Restore's got national coverage, which puts it in a really big position for all the big accountancy firms who are looking to slim down the number of suppliers that they're working with. And also, it deals with facility management departments. These are the same people that do office moves, same people that do shredding and IT recycling. So there's no wonder it's made acquisitions in that space, cross-selling opportunities. But here's the bear case. Growth is dependent on acquisitions. Sticky customers are good. They'll stay with you for a long time. But that also means that Restore's rivals, their customers are staying with them. So the only way to poach those customers is to buy the business. You can only buy so many businesses because they're, and otherwise you either get monopoly in the market, which it hasn't got, or they just don't want to be bought. The scanning side of things has got lots of competition from outsourcing companies, reprographic companies, software houses, and it's really hard to predict the pace of Restore's M&A in the future. The chief exec used to say to me, the big prize was, I'm going to buy Wincanton's document business, and it's done it. Where next? Acquisitive growth, in my opinion, is limited in document storage unless it goes overseas. There's no sign of that at the moment. But the office relocations business, that enters into very, very cyclical side of its business. You think about, if a company is uncertain about the state of the UK economy, is it really going to invest and move office? It's going to sit on its hands. So if we're now entering a period of very sort of uncertain UK economy, that means uncertain earnings for Restore's office relocations business. Lots of one-off projects, no guarantee of the repeat business, it pretty much assumes for the document storage side. And roughly half of its assets on its balance sheet are intangible assets. These are things from goodwill from acquisitions and customer relationships. But really, lots of investors want tangible assets, things you can touch. Things like property, that if something went wrong, it could sell it. And I think, what about the chief exec? Would he buy at today's price? Actually, I had a look through the director dealings since Mavin Wood became Restore. I can't find any evidence that the directors of the companies have actually bought shares using money out of their own pocket. And I don't know whether you follow director dealings, but really, if you're running a company and you think there's great value to be generated, you will see regularly, small and big companies, the directors are buying shares. There's no evidence here. They may get shares through the bonus scheme, but they're not putting their own money into it. So really, if you think about it, if Restore made no more acquisitions, you probably get a small amount of growth, but a lot of investors will want to leave because there's no exciting growth going forward. You may argue that a private equity company may want to buy the document storage, recurring revenue stuff, but they certainly wouldn't want the office removal stuff. There's no barriers to entry for any of these businesses, really. So, to me, I can't give investment advice. I'm a journalist, so I want you to go away, think about this company, and just a simple approach in these 10 minutes, how I've looked at the good and bad side. Apply that to all your investments. And really, if you want more ideas like this, Shares comes out every Thursday. You buy it in the shops. There's a website there. I'm not going to plug it. We've got a stand. You can come and have a chat with me afterwards if you want to. But I just want to use this as a great example of why a company with a rising share price can be good or can be bad. Thanks very much for listening.